Hello, Matthew Bell with InsurancePrescription.com. Today I wanted to talk to you about what you can do with the cash values in your life insurance policy. Now, not every insurance policy is going to have cash values associated with it. So, for example, term policies are not going to have cash values associated with them. There might be return of premium riders, but that's going to be a different thing altogether. Secondarily, sometimes universal life policies or sometimes other policies might be sold with an aim toward a particular end. So if a universal life policy or a survivorship universal life policy is sold for a legacy planning situation, then it might be that the cash values are going to dwindle, and they do that by design. And in that case, you don't want to count necessarily on the cash values in a policy like that, and it might be best to assume that there just aren't any. But for some policies, like whole life policies, certain universal life policies, cash value is going to be a major part of the policy's makeup, and cash value might be a major component of, let's face it, the sales pitch. It might be a major component of the attractiveness of the policy. So the question then arises, what can you do with the cash value once it's there? So there's going to be three main things that you can do with the cash value, and I'm just going to run through them quickly. Then I'll ask the question of what actually can you do with it practically? What can you spend the money on? And thirdly, what kind of returns can you expect? And it's going to depend on the policy type, but let's get into it. So the first thing you can do if you have cash value in your life insurance policy is you can withdraw it. You can make a partial withdrawal, or, and we'll deal with it in a minute more at length, is a full withdrawal. But let's think about a partial withdrawal for a moment. Often you can take a withdrawal of money, and that withdrawal, in many cases, is going to be tax-free. In some policies, the way the policy is constructed, the money might be able to be restored. You might be able to pay it back. And in other cases, a withdrawal is simply a one-way ticket. You can only withdraw it, and once it's withdrawn, then that money is gone from the policy and you can't add it back in. It's going to depend. You're going to have to consult with your agent in order to determine which policy you have. But if the money can be repaid and it's not repaid, then you can expect that it's going to negatively impact policy values. In the same way as if you withdraw the money and it cannot be repaid, then generally the negative impact is simply going to be crystallized. So for example, not only will the cash value decrease, but the death benefit might be negatively affected as well. And you'll have to check with your insurance agent for details on how a particular withdrawal that you contemplate might affect your policy values. Now, if the policy is from a dividend-paying company, then you also may have the option of withdrawing just the cash that is accumulated from dividends. So in a cash value policy, generally you're going to have a base cash value, and then if there are dividends, there may be an additional accounting of the cash that is associated with those dividends. It's generally going to at least be distinguishable. So if you request some kind of a policy summary and your policy is dividend paying, then you would be able to distinguish between the regular base amount of cash value and the dividend cash, and sometimes you can withdraw from one or the other or both. Now, if you just need a short-term infusion of cash or just a little bit of a bump, another thing to consider is that you can change the dividend option in the policy so that the policy's dividends are paid to you in cash at the appropriate time, or you can change the dividend option so that it offsets the amount of premium that you owe. So if you're paying an ongoing premium into the policy and you want to reduce that premium, or let's say you're paying a $500 a month premium and you could use an additional $500 a month, it might be that you can reduce or completely offset that premium amount with the dividends that are owed to you in that policy. Whether that's possible or not is going to depend on a lot of factors, and you're going to need to consult with your agent in order to determine whether that's an option for you. But any of these contemplated elections or changes are going to have negative impacts on policy growth projections. If you tinker with the dividend option, if you start taking cash out of the policy, then whatever policy projections for growth you were given when you initially purchased the policy all bets are going to be off. They're going to be completely different if you start tinkering with the policy in that way. The second option that you have, besides just withdrawing cash, whether partially or fully, is going to be to loan yourself the cash instead. So if you loan yourself the cash, this is going to be similar to if you give yourself a loan, let's say from your retirement account, like your 401k. You can take a loan from your 401k. Usually the interest rates are going to be lower than what you would be able to get on a personal loan at a bank or at a credit union. But you should be aware that one of the reasons you get a better rate is because this loan is, in a way, it is a secured loan. It's secured by the policy itself. So in the case where you take a loan against your life insurance, then the life insurance policy itself essentially goes into what's called a collateral assignment. So the policy becomes collateral against you defaulting against the loan. So for example, let's say that you have a $100,000 policy, you've got $20,000 of cash, just making the numbers up. Let's say you take a $10,000 loan and you don't pay it off and then you die. Well, in that case, the insurer is going to take the $10,000 outstanding from the death benefit when it is paid out to the beneficiary. So if you had a $100,000 policy with $10,000 outstanding in a loan, then the insurer is going to take $10,000 from the $100,000 and pay your beneficiary $90,000 in this example. So in other words, anytime you die with an outstanding loan balance, the loan will be discharged first before the beneficiaries are paid the death benefit. Now, how much the loan is and how close it is to the death benefit, only a look at your own policy particulars would indicate that, but you should be aware that although you do have the ability to take a loan, it will negatively affect the death proceed. Is it going to be dramatic? Maybe, maybe not. It depends on the application. And once again, the interest is accruing, so anytime the policy is discharged, anytime the policy loan is discharged, whether through the death proceed or through you paying it off, it's going to be the amount of money that you loan to yourself plus whatever rate of interest is assessed. Now the third option is that you could do a total cash surrender. So in other words, you could take all the cash out of the policy. Now this is the most drastic option because effectively this terminates the coverage that you have. It ends your relationship with the insurance company. You simply take all the cash available out and the policy is going to then end. At this point, we should also talk about a little bit about taxes. Now the disclaimer here, I am not a financial advisor, I'm not a tax advisor, I cannot give you insurance advice either. All this video is for general informational or entertainment purposes. If you need specific advice, you need to consult with licensed professionals in your area. If you totally cash your policy out, it is a taxable event. Now, whether you're going to pay tax on the money, in fact, depends on your situation. It also depends on what the cost basis is on the policy, namely, how much did you pay in? Any amount that you are given in a cash surrender that's over and above the cost basis is going to be taxed. Now, the whole thing is taxable, but whether it's taxed or not depends on your situation, your tax rate, the cost basis of the policy, and some other factors. Now, I should say that just like what happens if you have a credit card loan and the credit card loan, a portion of it, let's say, is canceled. If you have a portion of debt that's canceled, you get 1099 seed on that money and you would pay tax on the portion that's canceled. So in the event that you have a loan and the loan gets so large in the policy that the policy terminates, there would also trigger a 1099 report on that particular policy, and that money would also become taxable as well. Now, what can you do with money in a life insurance policy? Generally, the answer is you can do whatever you like. There aren't any restrictions, particularly on what you would be able to do with money that you loan yourself or cash out of a life insurance policy. You could use it to buy golf clubs. You could use it to pay a homeowner's deductible. There are any number of different things that you could do with the cash, and there really are no restrictions on that. This is unlike the 401k. So generally speaking, in a 401k, you have access to that money, just like in any retirement account, any qualified retirement account. You have access to that money after the age of 59 and a half. So once you hit 59 and a half, you may start taking money out of your retirement account for any purpose. Prior to that, you can only take penalty-free money out of a retirement account for certain emergency situations or certain permissible life events, like first-time homebuyer sometimes, medical expenses, if the account owner dies. There are exceptions, but if you just wanted to take money out to buy a car, you're going to pay a penalty on the money that you take out of your 401k. That's not the case with many life policies. Now, there's an asterisk there because there is a potential for a life insurance policy to be classified as a retirement vehicle, essentially, and the classification is called a modified endowment contract. Now, that modified endowment contract, or MEC, is treated by the IRS like a retirement account, and one of the consequences of that is that the 59 and a half rule applies. So if you think that might be an issue in your case, you'd want to consult with your agent. Probably want to consult with the agent in any case. Now, the fact that you can take money out of your life insurance policy for any reason doesn't mean that you should take it out. Like taking money out of a retirement account. If you take money out of your retirement account, you are probably setting your retirement plans back, unless it was a planned withdrawal, something that was built in when you first funded the policy. Your first thing is you might detrimentally affect your long-term plans. The second thing is that you will be missing out on long-term growth potential. The third thing is that you might also suffer an opportunity cost by having your money out of that account. If there's a gain in whatever, maybe it's a market-connected vehicle and there's some gain in the market, then if you had taken your money out, you'd miss out on the opportunity to take advantage of that gain. Now with a life insurance policy, it's going to depend on a number of factors, whether it's a good idea to take cash out of it or not. So for instance, whole life policies, universal life policies that are put in place, let's say for final expense planning, if you take cash out, then you should bear in mind that that cash is going to reduce potentially the death benefit of the policy, which is going to tend to negatively affect your final expense and end-of-life planning. On the other hand, if you funded the policy to be part of a life insurance retirement plan supplement, a LIRP, then in the case that you take cash out prematurely, just like if you withdrew cash from your retirement account in your 401k, you may detrimentally affect your long-term retirement plans. However, if you funded the policy or funded your retirement plan in order to take out the distribution or withdrawal that you are contemplating taking out, then maybe go ahead and take it, because if you planned for it and the policy was set up to accommodate it, then the policy is just doing its job by being available to you in that case. But in some cases, what we're talking about here is emergency cash, and if there's another way of getting that, you might want to explore all the options before you just look at the policy and say, oh wow, there's $10,000 in cash and I need $10,000, let me just take it out, because there might be consequences that you can't unwind. Now let me just briefly say, and this is probably going to need a longer treatment, but how much cash can you expect to be in the life insurance policy? And the answer is, it's going to depend. It's going to depend on a lot of different factors. Let me just run through a few briefly. For one thing, it's going to depend on what kind of policy it is. A whole life policy is going to tend to be more on the fixed side. It's going to be conservative, so its rate of return is going to be very low. But at the same time, you're not generally going to be in any danger of losing your principal in terms of market risk. If the market risk is removed, it's not on the table. But the flip side is that the potential for growth is generally not there either. It's going to be very modest, very predictable, very conservative growth. On the other hand, you might have universal life accounts that are what are called variable products, and these variable products generally have sub-accounts that are market connected. And so the benefit there is that you can take advantage of upturns in the market. So there's a positive upside potential to the policy. But whenever you have an upside potential, you also have a downside risk, and that is that you might lose the principal. So in a variable product, you can experience a market gain that's going to be above what you would expect in a whole life product, but at the same time, your principal is at risk. There's no guaranteed return. And that's similar to your 401k. What's the amount that is guaranteed to be in your 401k at retirement? And the answer is, generally speaking, unless you're invested in some conservative vehicle in the 401k, generally is, there is no guarantee. The amount in your 401k at retirement is what your investment experience is going to bear out for you. Now, somewhere in the vast middle ground between variable products and a whole life product is going to be something called an equity indexed life insurance policy. Sometimes these are called fixed indexed, sometimes these are simply called indexed life policies. But essentially what they are is they are tied to an index. So like the Dow Jones Industrial Average or the NASDAQ or the S&P 500, these policies are tied to the performance of the index. And so the idea is you can experience some growth, but usually the benefit to them is that they're going to have a floor on the amount of loss that you can experience. So let's say that the floor is set at 0%, but the index that year experiences a negative 25. If the index goes down by 25% and you have a 0% floor, that means the insurer is telling you, we will not take 25%. We're not going to credit you anything, but you're going to have a 0% gain that year, and that's your floor. It's the worst that can happen. Now, on the other hand, if they experience a 25% gain, generally in an indexed policy, there's going to be a cap on the amount of money that you're going to actually be able to get in terms of growth. So, if your cap is 8% or 10%, and there's a 25% gain in the market, you're going to get 8% or 10%. So it kind of, the idea is, I think, that the insurance company essentially, they get their money back because they don't give you the full gain in years that are essentially windfalls, but at the same time, you don't take the full brunt of the loss in years that go the other direction. Now you should bear in mind that when I say there's a 0%, let's say there's a floor, there's still probably going to be management fees and possibly transaction costs that are going to be associated with the account. So in a year where there's a considerable loss and you are credited nothing in the account, you still might see your balance creep downward, not because they credited some kind of a negative rate of return to your account, but because at 0% rate of return, the only place to pay the administrative and other fees is from the accumulated cash value, and so the cash value has nowhere to go but down. Now, final consideration when thinking about how much might be in the cash value is going to be your funding strategy. And it's going to depend here on the way the policy is set up and the way you choose to fund it. So for instance, in whole life, there's traditional whole life that's essentially paid up over the course of your entire life. So if you get it at the age of 6 months old, your parents buy it, then a traditional whole life policy is paid on until you die. If you get it at 40 years old, it's paid on until you die. If you get it at 60 years old, paid on until you die. So if you pay it over a course of a long period of time, then generally speaking, the premiums are lower and the cash value takes longer to build up. On the other hand, there are limited payment whole life plans that can compress that payment interval. So if, let's say, you pay off your policy in 20 years, or in 10 years, or in 5 years, or the limiting case here is what's called a single premium, which enables you to pay up a policy, pay it up fully with a one-time payment. If you do that, the cash value is going to grow much more quickly. So the cash value will grow much more quickly the shorter the interval is, with the limiting case essentially being the single premium policy. Now, once again, I mentioned earlier that in some cases a life insurance contract is going to be treated like a retirement vehicle, and it's called a modified endowment contract, or a MEC. And if you pay a policy up that in a very, very compressed interval, usually it's less than 7 years, but you have to look at the policy's mechanics in order to tell for sure. There are other policies that might be susceptible to this, but if you pay a policy up in fewer than 7 years, generally the IRS considers it to be a retirement vehicle, which, among other things, the 59.5 rule becomes applicable to that contract forevermore. Now, the more stretched out the premium is, again, the longer the cash value takes to accumulate. And you should be aware that if you do cash out a policy that has been a traditional pay policy and you cash it out before there's momentum on the cash accumulation, then you're probably going to get less out of it than you put into it in the first place, which is a good thing from a tax standpoint, but it's a bad thing from the standpoint of just a return on your money. But again, life insurance policies are generally, for the most part, gotten for death benefits, and so some of these living benefits or some of these things that we're considering now are in many cases a secondary consideration. It all depends on the circumstance and how the policy is set up and for what purpose. Now, the final thing I'll say is that the qualifications for these policies, you have to bear in mind, these are life insurance policies. And so the policy values that you see are going to be in part a function of how healthy you are. So for instance, if you're very healthy, your policy values are going to tend to be more favorable than a person who's not healthy. And of course, if you are unhealthy to a particular degree, then you may not even be able to qualify for a policy like this in any case. Now, there's a tricky part that, for example, if you qualified for a policy when you were healthy and you've subsequently become unhealthy, you want to think twice about canceling or cashing out or loaning against a policy that was obtained when you were healthier. Because chances are, again, if you're unhealthier and you are significantly unhealthier, you may not be able to replace that policy at all. Maybe it matters for your situation and maybe it doesn't, but you'd want to at least consider that before you threw a switch that you couldn't unthrow. Finally, your age is going to play a role. This is kind of a function of the underwriting, but obviously a 79-year-old and a 59-year-old, their policy value projections are going to look very different, even if they're the same underwriting classification because of their age difference. So I can't tell you what to do with your cash value or what option to elect. This is not advice of any kind. If you need personalized recommendations, you need to consult with a licensed professional in your area. But if you did find something of use in this video, I invite you to like it, subscribe to the channel, click the notification bell to be alerted to new content as it becomes available. I thank you so much for joining me today, and I look forward to seeing you again in another video. Thank you.